There's a pattern in history that has destroyed three major financial systems in the last 700 years. And right now in 2025, China is following that exact same pattern step by step, trillion by trillion, almost like they're reading from a script written by Florentine bankers. In 1340, the Medici bank pioneered bills of exchange. They revolutionized European trade and became the most powerful financial institution in the world. Within 150 years, bad debts destroyed them and triggered the first modern banking crisis. In 1890, Barings brothers financed the railroad boom across Latin America. They were the most respected bank in Britain, the bank that financed the Napoleonic Wars. They collapsed in weeks from Argentine railway bonds and nearly took down the entire British banking system. In 2015, China's shadow banking system had grown to $60 trillion. Wealth management products, trust companies, peer-to-peer lending, all financial innovations that expanded credit massively. By 2025, bad debt is everywhere and the crisis is being suppressed only through government intervention that can't last. 3 times. 3 financial innovations. 3 credit expansions. 3 bad debt accumulations. 3 crises. All following the exact same 4-stage sequence. And here's what should terrify you. China has completed 3 of the 4 stages. We're not approaching the crisis. We're watching it unfold in slow motion. This is the story of how credit traps destroy economies, why bankers always think their innovation is different, and why the math says China is next. And when China's credit system collapses, it takes the global economy with it. Before we go through the pattern, you need to understand what a credit trap actually is. Not a banking problem, a mathematical inevitability built into credit expansion. The credit trap is what happens when financial innovation enables credit growth faster than real economic growth. It sounds technical, but the mechanism is simple and brutal. Stage 1: Financial innovation. Someone invents a new way to create credit. A new financial instrument. A new lending structure. A new market. The innovation is genuine. It solves a real problem. It enables economic activity that couldn't happen before. Stage 2: Credit expansion. The innovation works. Profits are made. Everyone wants in. Banks copy the innovation. Regulations are loosened to enable it. Credit expands exponentially. Money is lent to anyone. Standards drop. Risk is ignored. The assumption is that growth will continue forever. Stage 3: Bad debt accumulation. The credit expansion reaches people and projects that can't repay. The loans are made anyway because everyone is making loans. To stop lending is to miss profits, while competitors gain. The bad debts accumulate slowly at first, then rapidly. But they're hidden. Marked as performing. Rolled over. Extended. Nobody wants to acknowledge the problem. Stage 4: Crisis. Something triggers recognition. A default, a scandal, an investigation. Suddenly everyone realizes the debt is bad. They stop lending. They demand repayment. The borrowers can't pay. They default. The defaults cascade. The crisis explodes. And the financial system that enabled the credit expansion collapses. This has happened 3 times in documented history to major financial centers. Let me show you how it played out. Let's start with the first modern credit trap. Florence, Italy, 1340 to 1494. The Medici Bank and Bills of Exchange. In the 1300s, European trade was growing but constrained by a fundamental problem. Moving money was dangerous. A merchant in Florence selling cloth in London needed payment. But moving gold from London to Florence meant hiring armed guards, risking robbery, paying transport costs. The risk and expense were enormous. Italian bankers invented a solution. The bill of exchange. Stage 1: Financial innovation. Here's how a bill of exchange worked. A Florentine merchant ships cloth to London. Value: 1,000 florins. The London buyer doesn't pay in gold. Instead, he goes to a Florentine bank's London branch. He deposits 1,000 florins worth of pounds sterling. The bank gives him a bill of exchange. A piece of paper. The merchant ships the bill of exchange back to Florence. The Florentine seller takes the bill to the bank's Florence branch. The bank gives him 1,000 florins minus a small fee, maybe 2%. No gold moved. No transport risk. No robbery risk. The bank made 2% for enabling the transaction. This was revolutionary. Bills of exchange enabled long-distance trade without moving precious metals. They were safer, faster, and cheaper than any previous method. The innovation worked. Trade expanded. The banks using bills of exchange made fortunes. And the Medici family perfected the system. The Medici Bank was founded in 1397 by Giovanni di Bicci de' Medici. His son Cosimo expanded it into the most powerful bank in Europe. By 1450, the Medici had branches in Florence, Rome, Venice, Geneva, Bruges, London, and Avignon. They handled bills of exchange for merchants across Europe. They financed trade routes. They collected papal taxes. They lent to kings. And they were printing money. Not literally, but effectively. Because bills of exchange created credit. Here's how. A merchant in Florence wants to ship goods to London. He doesn't have cash to buy the goods. He goes to the Medici Bank. The bank lends him 1,000 florins. He buys the goods and ships them. The London buyer pays with a bill of exchange. The bill is payable in 90 days. The Florentine merchant takes the bill back to the Medici Bank. The bank gives him 1,000 florins immediately minus a discount. The merchant repays his loan. Everyone is happy. But notice what happened. The bank lent 1,000 florins that will be repaid in 90 days. But they gave the merchant 1,000 florins immediately for the bill of exchange. They've now lent 2,000 florins against future payment of 1,000 florins. This is credit creation. As long as the bills are repaid, the system works. The bank can lend more than it has because the bills circulate as money. Bills of exchange became a form of currency. Merchants accepted them as payment. They traded hands multiple times before being redeemed. The Medici Bank created a massive credit expansion using this mechanism. Stage 2, Credit Expansion. By 1450, the Medici Bank had outstanding credit of over 3 million florins. Their capital was about 90,000 florins. They were leveraged 33 to 1. For every florin of capital, they had 33 florins of credit outstanding. This is massive leverage. But it worked because European trade was booming. The bills were repaid. The system seemed safe. And the Medici expanded further. They started lending to kings. Edward IV of England. Charles the Bold of Burgundy. Multiple popes. Kings borrowed huge sums using bills of exchange as collateral. The Medici would lend 100,000 florins to a king. The king promised repayment from future tax revenue. The promise was documented with a bill. The bill circulated. Other banks accepted it. The credit expanded beyond real money. And here's where stage 3 begins. Bad debt accumulation. Kings don't always repay. Edward IV borrowed 60,000 florins from the Medici London branch in the 1460s. He never fully repaid. He died in 1483. His debts were contested. The Medici marked the loans as performing. They kept them on the books at full value. But the money was gone. Charles the Bold borrowed heavily to finance wars. He died in battle in 1477. His debts died with him. The Medici lost 16,000 florins. Again, marked as performing until it couldn't be hidden. The papal loans were especially dangerous. The Medici lent to multiple popes to finance church operations and wars. Popes die. New popes repudiate old debts. By 1478, the Medici had accumulated significant bad debts from kings and popes. But they couldn't admit it. Admitting insolvency would cause a bank run. So they hid the losses. They rolled over bad loans. They issued new bills to cover old bills. They created more credit to hide the bad debt. Stage 4, Crisis. In 1494, the crisis hit. King Charles VIII of France invaded Italy. The Medici were expelled from Florence. Their political protection vanished. Without political power, their debtors stopped paying. The bills of exchange became worthless. The credit structure collapsed. The Medici bank branches across Europe closed between 1494 and 1500. The depositors lost everything. The bills circulating as currency became worthless. Trade across Europe contracted because the credit system was broken. This was the first modern banking crisis. And the pattern was clear. Financial innovation, bills of exchange, enabled credit expansion. Credit expansion created leverage. Leverage concealed bad debt accumulation. Crisis revealed the bad debt and destroyed the system. The Medici weren't alone. Other Florentine banks using the same system collapsed around the same time. The Bardi and Peruzzi banks had collapsed earlier in 1340s. The Strozzi and Pizzi banks failed in the 1460s. The pattern repeated. Every bank that expanded credit using bills of exchange eventually accumulated bad debt and collapsed. The mechanism was mathematical. When credit grows faster than real economic activity, some credit must be bad. And when enough credit is bad, the system fails. Let's jump forward 450 years. London, 1890. Barings Brothers and the Argentine railway bonds. This is the second test of the pattern. In 1890, Barings Brothers was the most prestigious bank in Britain. Founded in 1762, they had financed the Napoleonic Wars. They financed the Louisiana Purchase. They were the merchant bank to royalty and governments. The partners were among the richest men in England. And they pioneered a new financial innovation: sovereign bond underwriting. Stage 1: Financial innovation. Before the 1800s, governments borrowed directly from banks. Small loans. High interest. Limited scale. But in the 1800s, governments needed massive funding for infrastructure. Railways. Ports. Telegraph lines. No single bank could provide enough capital. British investment banks invented a solution: sovereign bonds. Here's how it worked. The Argentine government wants to build railways. Cost: £10 million. No single bank will lend $10 million. Barings Brothers structures a bond offering. They divide the $10 million into 10,000 bonds of £1,000 each. They sell the bonds to wealthy British investors. The investors receive 5% annual interest paid by Argentina. Argentina receives $10 million to build railways. Barings Brothers receives a 3% underwriting fee plus ongoing commissions. £300,000 upfront for arranging the deal. Everyone wins. This was revolutionary. It enabled governments to borrow at scales never before possible. And it enabled British investors to earn returns on foreign investments without traveling abroad. The innovation worked. Railways were built. Investors were paid. Barings made fortunes. Stage 2: Credit expansion. From 1860 to 1890, Barings underwrote hundreds of millions in bonds for Latin American governments. Argentina, Brazil, Uruguay, Chile. All building railways, ports, and infrastructure. British investors loved these bonds. 5% to 6% annual interest. Government-backed. Payable in gold. Seemed safe. Demand was insatiable. And Barings kept issuing them. By 1880, Argentina had borrowed £50 million from British investors through Barings. The money funded 5,000 miles of railway. The railways were supposed to generate revenue. Farmers would ship crops. Passengers would pay fares. The revenue would cover bond interest. That was the theory. But Argentina's economy wasn't growing fast enough to generate the revenue. The railways were built through empty pampas. No crops. No passengers. No revenue. The bond interest was being paid not from railway earnings but from new bond issues. Argentina was borrowing to pay interest on existing debt. Classic Ponzi scheme. Barings knew this. But they couldn't stop. To stop issuing Argentine bonds was to admit the existing bonds were bad. That would crash the market. Barings' reputation would be destroyed. So they kept issuing. They underwrote new bonds to help Argentina pay interest on old bonds. The credit expansion continued. By 1890, Barings had underwritten £90 million in Argentine debt. Their capital was £3 million. They were leveraged 30 to 1. And they held large amounts of unsold Argentine bonds on their own books. They couldn't sell them. Investor demand had dried up. But they couldn't mark them down. That would show losses. Stage 3. Bad debt accumulation. By 1889, it was obvious Argentina couldn't pay. The railway revenues were 1/10 of projections. The government was bankrupt. Inflation was exploding. The currency was collapsing. Barings had £15 million of unsold Argentine bonds. They were marked at face value on Barings' books. But they were worthless. Nobody would buy them. Barings tried to hide the problem. They used short-term loans to cover cash shortfalls. They borrowed from other banks. They issued their own promissory notes. They kept declaring to the market that Argentina was sound. But behind the scenes, the partners knew. They were insolvent. The bad debt had consumed their capital. And in 1890, the crisis hit. Stage 4 crisis. In July 1890, Argentina suspended debt payments. Default. The Argentine bonds crashed. Barings' $15 million in holdings became worth $3 million overnight. $12 million loss. Barings' capital was $3 million. They were insolvent by £9 million. The partners tried to hide it. But banks talk. Other banks heard Barings was in trouble. They stopped lending to Barings. Demanded repayment of existing loans. Barings couldn't pay. On November 8, 1890, Barings brothers informed the Bank of England they would collapse by the end of the week. The most prestigious bank in Britain. Nearly 130 years old. Financing partner to governments. Insolvent. The Bank of England realized if Barings collapsed, the entire British banking system could follow. Barings had borrowed from every major bank in London. If Barings defaulted, those banks would take losses. Some would become insolvent. They'd default on their obligations. The cascade would destroy the financial system. The Bank of England organized a bailout. They convinced a consortium of banks to inject £17 million to keep Barings alive. The bailout worked. Barings survived, though they were effectively nationalized. The partners lost everything. The crisis was contained. But the damage was done. Argentine bonds became worthless. British investors lost hundreds of millions. Investment in Latin America froze for a generation. And the lesson was ignored. Within 30 years, banks were making the same mistakes with different instruments. The pattern repeated. Financial innovation, sovereign bonds, enabled credit expansion. Credit expansion concealed bad debt accumulation. Crisis revealed the bad debt and destroyed the bank. Barings learned nothing. In 1995, they collapsed again from bad derivative trades. The same pattern. Different instrument. Same outcome. Now let's look at the modern example. China, 2008 to 2025. The shadow banking system and wealth management products. This is the third test, and it's the largest credit expansion in human history. In 2008, China's banking system was relatively simple. State-owned banks lent to state-owned enterprises. The government controlled everything. Total credit was about 120% of GDP. Normal for a developing economy. Then the 2008 financial crisis hit. China's exports collapsed. The economy was heading for recession. The government panicked. They ordered banks to lend. Massively. Banks lent 4 trillion yuan in stimulus. That's $586 billion in 1 year. It worked. China avoided recession. But it created a problem. The state-owned banks had lent to everyone. Good projects. Bad projects. Didn't matter. Lend. By 2010, many of those loans were already non-performing. But the banks couldn't admit it. That would require writing off losses. So they rolled them over. Extend and pretend. The bad debt accumulated. And demand for credit kept growing. Developers wanted to build. Local governments wanted infrastructure. Entrepreneurs wanted to expand. But the banks couldn't lend more. They'd reached regulatory limits, credit to deposit ratios, capital requirements, loan to GDP limits. They were constrained. So they invented a solution: shadow banking. Stage 1: Financial innovation. Shadow banking in China is lending that happens outside the regulated banking system. The innovation came in multiple forms: wealth management products, WMPs, trust companies, peer-to-peer lending platforms, local government financing vehicles, all doing the same thing: creating credit outside regulatory limits. Let me explain how WMPs work. This is the biggest piece. A bank wants to lend 1 billion yuan to a property developer. But they've reached their regulatory limit. They can't make the loan directly. So they create a wealth management product. They sell the WMP to investors. Promise return, 8% annually. The investors give the bank 1 billion yuan. The bank lends the 1 billion to the property developer. But here's the trick. The loan doesn't appear on the bank's balance sheet. It's held by the WMP. The WMP is a separate entity. Technically, the bank just manages it. The investors bear the risk. Supposedly, this allowed banks to lend unlimited amounts without violating regulations. By 2012, WMP sales reached 7 trillion yuan. By 2015, 23 trillion yuan. By 2017, 30 trillion yuan. That's $4.3 trillion. And that's just WMPs. Add trust company loans, peer-to-peer lending, local government financing vehicles. Total shadow banking reached 60 trillion yuan by 2017. That's $9 trillion. 80% of GDP. This was credit expansion on a scale never seen in history. China's total credit, official plus shadow, went from 120% of GDP in 2008 to 260% of GDP in 2017. Credit grew 140 percentage points in 9 years. For comparison, US credit grew 40 percentage points before the 2008 crisis. Japan grew 50 percentage points before their 1990s crisis. China grew 140 points. Unprecedented. Stage 2: Credit expansion. The shadow banking credit flowed everywhere. Property developers borrowed billions to build apartments nobody wanted. Local governments borrowed to build highways to nowhere. Factories borrowed to expand capacity already in oversupply. State-owned enterprises borrowed to stay alive despite losing money for years. And everyone borrowed knowing they'd never repay. Because in China, debts don't have to be repaid. They can be rolled over forever. As long as credit keeps expanding, old debts are paid with new debts. The Ponzi scheme continues. And the scheme was massive. By 2020, China had built enough empty apartments to house 90 million people. They'd built 50,000 miles of high-speed rail, much of it running at 20% capacity. They built ports, airports, bridges, roads, far beyond any economic need. The construction employed millions. The credit funded it. But the projects didn't generate revenue. The apartments sat empty. The trains ran at losses. The local governments couldn't repay loans. Neither could the developers. Neither could the factories. But nobody declared bankruptcy. The debts were rolled over. New shadow banking loans paid off old shadow banking loans. The credit expansion continued. And the bad debt accumulated. Stage 3: Bad debt accumulation. By 2015, sophisticated observers knew the problem was catastrophic. Autonomous estimates suggested 15% to 20% of shadow banking loans were non-performing. That's 9 to 12 trillion yuan. $1.3 to $1.7 trillion in bad debt. But officially, the bad loan ratio was 1.5%. The banks claimed everything was fine. The truth? The banks were hiding the losses through shadow banking. A loan goes bad on the official books. The bank creates a WMP, sells it to investors, uses the money to pay off the bad loan. The bad loan disappears from the official books. It's now held by the WMP. The investors don't know it's bad. It's marked as performing. The bad debt is hidden. This mechanism allowed China to hide trillions in bad debt. But hiding it doesn't make it disappear. The debt is still there. And it's growing. Because bad borrowers don't suddenly become good. They keep borrowing. They keep defaulting. They keep being rolled over. By 2020, multiple estimates put total bad debt in China at 30 to 40 trillion yuan. That's $4.3 to $5.7 trillion. 30% to 40% of GDP. This is bad debt on a scale larger than the US subprime crisis. And it's still being hidden. How do we know? Because the defaults that slip through are enormous. In 2021, Evergrande, China's second largest property developer, defaulted on $300 billion in debt. The largest default in history. It barely made news because it was expected. In 2022, dozens of property developers defaulted. Country Garden, Shermao, Sunac, all multi-billion-dollar defaults. In 2023, the defaults spread to trust companies. Zhongrong Trust, $16 billion in failed payments. In 2024, peer-to-peer lending platforms collapsed. 2,000 platforms went bankrupt. $200 billion in investor losses. These are the defaults that couldn't be hidden. They're the tip of the iceberg. The bulk of bad debt is still concealed through rollover and government support. And the concealment is becoming impossible to maintain. Stage 4 Crisis. We're entering Stage 4 now. Not full crisis yet, but the containment is breaking. The Chinese government has been intervening to prevent crisis since 2017. They've banned new shadow banking products. They've forced banks to bring WMPs onto balance sheets. They've injected capital into failing banks. They've restructured local government debt. They've bailed out property developers. They've suppressed interest rates to keep borrowers solvent. It's worked so far. The crisis hasn't exploded. But the interventions are costing more and more. In 2020, China injected 1 trillion yuan into the banking system. In 2022, 2 trillion. In 2024, 3 trillion. The bailouts are accelerating. And they can't continue forever. Why? Because China is running out of money. The government debt is now 80 trillion yuan. That's $11 trillion. 85% of GDP. Local government debt is another 60 trillion yuan. Total government debt, 140 trillion yuan. 140% of GDP. And it's growing at 10% to 15% annually. The government is borrowing to bail out the banking system. But who bails out the government? The question is, when does the crisis go critical? What's the trigger? Maybe a major bank fails and can't be bailed out. China Construction Bank or Industrial and Commercial Bank of China holding 5 trillion in assets. If one declares insolvency, the contagion spreads instantly. Maybe local governments stop paying debts. 30 provinces defaulting simultaneously. The central government can't bail them all out. Or maybe it's property developers. If the top 10 developers all default within months, the losses overwhelm the system. Or maybe it's wealth management products. If investors realize their WMPs are worthless, they demand redemption. The banks can't pay. Bank runs begin. Or maybe it's external. A trade war. A Taiwan crisis. Capital flight. Foreign investors pull money out. The yuan crashes. The debt becomes unpayable. The specific trigger doesn't matter. The mathematics say crisis is coming. China has 300% debt to GDP. 40% of it is bad debt. That's 120% of GDP in losses. Someone has to absorb those losses. Banks. Investors. The government. Taxpayers. The losses can be distributed, but they can't be eliminated. And distributing 120% of GDP in losses destroys the financial system. It destroys trust. It destroys credit. It destroys growth. China is facing the same crisis the Medici faced in 1494. The same crisis Barings faced in 1890. Financial innovation, shadow banking, enabled credit expansion. Credit expansion concealed bad debt accumulation. And crisis will reveal the bad debt and destroy the system. Let me show you the exact parallels. Medici Bank, 1450. Outstanding credit, 3 million florins. Capital, 90,000 florins. Leverage, 33 to 1. Bad debt, 30% to 40% of loans. Time to crisis, 44 years from peak. Barings Brothers, 1890. Outstanding credit, 90 million pounds. Capital, 3 million pounds. Leverage, 30 to 1. Bad debt, 80% of Argentine exposure. Time to crisis, 6 months from recognition. China, 2025. Outstanding credit, 300 trillion yuan official plus shadow. Capital, reserves of 20 trillion yuan. Leverage, 15 to 1 in banking system, 30 to 1 in shadow banking. Bad debt, 30% to 40% of shadow banking loans. Time to crisis, unknown, but the pattern says soon. The parallels are exact. The leverage ratios are similar. The bad debt percentages are similar. The concealment mechanisms are similar. Only the scale is different. China's credit bubble is 100 times larger than any previous bubble in history. And when it pops, the global consequences are catastrophic. Why? Because China is 18% of global GDP. China is the largest trading partner for 120 countries. China holds 3 trillion in foreign reserves. China owns 1 trillion in US Treasury bonds. When China's financial system collapses, the effects cascade globally. Chinese demand for commodities disappears. Oil, copper, iron ore all crash. Commodity exporters, Australia, Brazil, Saudi Arabia, enter recession. Chinese imports stop. Manufacturing exporters, Germany, Japan, South Korea, enter recession. Chinese investments abroad are liquidated. Property markets in London, New York, Sydney crash. Chinese-owned debt defaults. Belt and Road countries, Pakistan, Sri Lanka, Kenya, can't repay Chinese loans. They default. And the financial contagion spreads. Banks holding Chinese debt take losses. Investors holding Chinese assets take losses. The losses are measured in trillions. Multiple countries face banking crises simultaneously. The 2008 crisis was 2 trillion in losses concentrated in US housing. The China crisis will be 5 to 10 trillion in losses spread globally. It will be the largest financial crisis in history. And it's already baked in. The bad debt exists. The leverage exists. The only question is timing. 3 times. 3 financial innovations. 3 credit expansions. 3 bad debt accumulations. 3 crises. All following the exact same 4-stage pattern. Medici bills of exchange. Barings sovereign bonds. Chinese shadow banking. The innovation is always different. The pattern is always the same. Leverage conceals bad debt until crisis forces recognition. And right now in 2025, China is at the edge of stage 4. The bad debt is 30% to 40% of shadow banking. That's $5 trillion. The bailouts are accelerating. The government interventions are failing. The property market is collapsing. The trust companies are failing. The peer-to-peer platforms are gone. The only thing preventing full crisis is government suppression. And suppression can't last forever. Eventually, the mathematics overwhelm the politics. The bad debt must be recognized. The losses must be absorbed. The crisis must happen. And when it does, it makes 2008 look small. Because China's credit bubble is the largest in history. The leverage is extreme. The bad debt is massive. And the global exposure is total. The question isn't if China's credit trap collapses. The question is what triggers the final crisis, how fast it spreads, and whether the global financial system can survive the implosion of 18% of world GDP drowning in bad debt that was hidden for 15 years through financial innovation that everyone knew was fraud.